Hi, this is Natalie Pace, and the Genius Act was signed into law earlier last week, and we're going to be discussing whether or not stablecoins are stable and should be on the safe side, or whether or not they should be considered at risk. We're also going to be discussing other cryptocurrencies because crypto is becoming very mainstream. You can actually have ETFs and you can put them in your individual retirement account where you don't have capital gains if you capture gains. So we're going to talk a little bit more about our safe haven strategy, which now includes stablecoins, Bitcoin, Ethereum, and other cryptocurrencies. All right. Remember, you can always watch it back at youtube.com/Natalie Pace. And please share with your friends because it's free. And be sure that you're on our mailing list and following me on Instagram. My name is Natalie Wynne Pace, Wynne. Info at nataliepace.com if you want to join our mailing list, or if you have any questions or comments, we want to hear from you. So let's get started. Want to start with my PowerPoint presentation. So again, Bitcoin is on fire and stablecoins have become mainstream. And the interesting thing, and by the way, I just did a blog on this. I did, a half year update on what has been performing the best so far this year. And the interesting thing is that we keep hearing daily, and they are, stocks are at an all-time high. But if you aren't digging into the details, you're not aware of the fact that the safe havens have been the super performers, and specifically silver, because we have been hearing Bitcoin's at an all-time high and gold's at an all-time high, but we haven't been hearing about that silent superstar silver, which has had the best performance this year so far, year to date. So again, here's what has really been happening. This is by sector. Obviously, Tesla has really suffered this year. It was, doing great last year when the current administration won the election, but not as well this year. Now, one of the topics of today is to talk about the stable coins. Are they really stable? Are they really a safe haven? And we have to read the fine print very carefully. Now, what do I mean by that? First of all, I just did a blog on stable coins the minute that they were passed. So I do encourage you, you might have to reach out to info@nataliepace.com just to get the link. Just put stablecoin blog in the subject line and we're happy to send you a link. It's free. But here's what you can do also. Just go to nataliepace.com/blog. This is the most recent blog, but at the end of each one of these, I have a list of the more recent blogs. So you'll be able to access it right there. Crypto goes mainstream. The Genius Act becomes law. So if we look over there, what you'll see is that I do discuss a lot of different things that you need to be thinking about with regard to both crypto and stable coins. Now, one of the things, which is the question we just posited, are stablecoins stable? Should you be putting them on the safe side? And the truth of the matter is that if you're looking at the website, you have to make sure that you're looking in the right place, right? So this is the World Liberty Financial. They have a stable coin and they say it is redeemable one for one for US dollars. It is. And that is one of the things that the Genius Act did is it said, look, if you're going to have a legal stable coin, you must back it by US dollars or US treasuries. Or there may be some that are doing it by euro, and they'll tell you if they're backed by the euro, 1 for 1. But the dollar has been weakening, so that does shift the dynamics. Of course, they're supposed to make up that difference, but it's important to realize that that does carry a little bit of risk to it. Also, it says here USD1 is backed by dollars and US treasuries that have the full faith and credit of the US government. Now, if you missed that word that, then you might think that this stable coin has the full faith of the US government. And that's what I'm seeing a lot is that a lot of people are not reading the fine print carefully enough. Now, if you were to go to the actual risk page of that same exact website, and here it is, you can see in bold letters that this is not government backed, right? But if you're just reading the marketing campaign, then you're not maybe understanding the full thing. So again, it is not legal tender and it is not government backed. So stable coins, they don't offer a yield or a dividend either. They are very similar to money market funds, but without the yield, that may change going forward. I just haven't seen a yield going on yet with many of the stable coins that I see offered. Um, and like money market funds, they do have some risk attached to them. So a lot of people aren't even aware of that money market funds have risk attached to them. They're not FDIC insured. They're supposed to maintain their value, but they can go down in value. And in fact, in recessions is when they tend to get into trouble. We bailed out a lot of money market funds in the Great Recession. So it's important for us to understand what is safe in a world where there's a lot of debt and stocks are at an all-time high, and we may be a little overdue. There's a small chance of a recession this year. Many economists have put it at 35% or less. So it's not necessarily guaranteed to happen, but things can move quickly and change quickly. And there certainly is a lot of risk out there in the world. So I would say, with all the paper losses and everything, that we want to make sure our safe side is not going to suffer from paper losses, that it will not go down in value. And yeah, the stable coins are not supposed to go down in value, and neither are money market funds that are designed not to, but there are scenarios where they can. And we're going to talk about at least one of those scenarios now. So let me go back to the PowerPoint real quickly and then we'll come back. Yeah, let's go ahead and talk about some of the scenarios where they can go down in value. So it's important to remember that we saw Terra Luna's stable coin collapse in May of 2022. And those investors in that stable coin are not expected to get like less than 5% of their money back, right? It's not FDIC insured. It's not backed by the government, and it's not backed by, yeah. So you have to be aware of that. Now, that was also a crypto winter. It rippled throughout the entire Bitcoin world. So we will talk a little bit more about how you can mitigate that if you do wish to invest in crypto at all. But it's important to understand that. So I'm encouraging people, before you jump into stable coins and or Bitcoin even, be sure that you understand the risks involved. Another real important risk is actually the Ponzi schemes and the fraud, especially with AI, because sadly, I am seeing people taken in by Ponzi schemes and fraud ever since Bitcoin was launched. The Bitcoin Trading Club. There's been all kinds of ones that have been caught after the fact, of course, after they've already stolen your money. But even more recently, somebody mocked up and was a mentor to somebody, and they were showing that all the gains that they were making in their statement, that was all a complete fraud, a complete lie. And this person borrowed at a high interest rate on a credit card in order to put $40,000 in there. And of course, the fraudster completely disappeared after that. So it's super important for us to be aware of these pitfalls. And again, I do outline them in great detail in that blog. Okay, so be sure that before you jump into stablecoins or Bitcoin, you should be reading that blog here. Crypto Goes Mainstream. Email info@nataliepace.com if you have a hard time finding it. So should you incorporate some hot things in your wealth plan? And I would say yes, but you need to have a strategy for doing so. And Bitcoin has been so hot that its returns make everything else look almost like nothing, right? So Bitcoin more than doubled in 2024. It was up 170% in 2023. So it was super hot, right? And what do you do with that? Well, that's why you have an age appropriate, properly diversified plan. If you do wish to get hot, you have 4 hot slices to do it. And even more importantly, if you are rebalancing once, twice, or 3 times a year, that is a capture gain strategy. So with Bitcoin at an all-time high, if you started investing a few years ago and you had 2 hot slices, if you have half of your portfolio in there and you're over the age of 50, it's time to capture gains. Yes, Bitcoin can keep going up. That's why it's not all or nothing, right? Capture gains, trim it back to a slice or two. If it keeps going up, then the next time you rebalance, you'll be capturing gains again. If it goes down and reverses direction, you'll have kept your wealth and you have the liquidity to buy low, right? So this particular strategy, age appropriate, properly diversified, actually puts you on the right side of the trade if you're rebalancing once, twice, or three times a year. And it works great whether you think quantum computing, AI, electric vehicles, whatever you think is hot, you get to choose, right? And put it in that hot slice. There's one other consideration with stocks at an all-time high and Bitcoin at an all-time high. Is the good news already priced in? It's human nature to want to buy high, and it's human nature that when things go down. In April, we could have purchased for 20% discount, but at that time you might be thinking, "Oh no, we have tariffs. I don't know," right? And that's why that rebalancing helps us. If it's a smaller slice, it's saying buy a little more at a lower price. If it's a super, four slices, it's saying sell high and trim it back, get age appropriate and properly diversified. So these are important things to remember that it's literally so much easier once you learn the pie chart system than, just having to have blind faith that somebody else is doing it for you. So again, this system with the rebalancing prompts us to do the right thing. If we're just working off the brokerage statements, we don't include our checking and our banking, our crypto accounts, or whatever other liquidity we have, then we're not seeing a full picture of what we have or what we might have safe or not enough safe, right? If we're just working. Plus, the brokerage statements have green and red, and they have pluses and minuses. So they're actually jacking our emotions in the wrong direction. Green, plus, you're winning, keep going, right? Red, minus, oh no, you lost, stop losses. And that is a losing strategy. That's on the wrong side of the trade. So both for the emotional quotient as well as the full picture quotient, we need to be putting all of our assets, our liquid assets, into that Excel file for a pie chart view that we can compare to what we should have. And that tells us, it makes it super easy. Oh, I have too many slices, trim it back, sell high. Oh, my slices are too small. Do I still think it's hot? Oh, if so, let's buy more at a lower price, right? So whether you are investing, whatever it is that you think are hot, and again, I did a blog about Tesla Vision versus LiDAR. I also did a blog on air taxis. So, if you think any of these things are hot, then just go to nataliepace.com and put in whatever you think is hot in the search file. Chances are I've written a blog on it, or email info@nataliepace.com because maybe I want to do a blog on something that you think is super hot. And I also want to show you how easy it is to get hot in targeted ETFs. We use in our financial freedom retreat, we use iShares as our example because it is owned by BlackRock and it is publicly traded. It's got a double A minus credit rating. So this is a lot of the things that we really want in our funds is to make sure that that it's a creditworthy fund company that we're actually buying from. But let's say, oh, here, I'm just going to go to the search box here and I'm going to put in electric vehicles and see what comes up. So okay. Um, sometimes their search bots are not as great. I could probably go to Google and get it more easily. I know it's called iDrive. So let's see here. Self-driving EV and technology ETF, right? Now, if I'm interested in artificial intelligence, let's see what happens. And they have Artie right there. They're also telling you more about iDrive. If I'm interested in, and I know this symbol, it's Tech B, the Magnificent Seven. Breakthrough Technology is going to have a lot of our, Magnificent Seven in the top holdings. So again, it's very easy to get a hot slice, and the fund itself reduces the risk of holding just one company. And you can get very, very targeted in something that you think might be super hot. So, as I always want you to do is to know where the data and statistics and analysis are. A lot of people are concerned about the public debt. 37 trillion in the US, they don't know that the total debt and loans is actually 103 trillion. Or they may not even know that half of the S&P 500 is at or near junk bond status, including a lot of banks. So we are using value fund replacements as a reason for that after all that data statistics and analysis, because what's a value when stocks are at an all-time high? Nothing's on sale, plus all the leverage. Now, our value replacement funds are in countries that give us country diversification and also have lower debt to GDP and higher GDP expectations for this year. And sometimes many of them are actually paying a dividend that's higher, sometimes even double of what the US is paying. So these are important. And in fact, one of our value replacements is actually one of the super performers this year. So I just did a blog talking about the performance, which I showed you at the beginning of this, right? Silver, top performer, that's one of our hot slices. We leaned into that rather than gold. There were reasons for that, but you can see they're both doing well. Bitcoin could be one of your hot slices. I would suggest in a Roth IRA or a TFSA if you can, so that you avoid capital gains taxes. EPU was our mid or small cap value replacement. That's Peru. That was a play on copper. So a lot of our hots are doing very, very well. And again, it's super easy to get that. Now, the other reason for rebalancing is that things that are sometimes the hottest can be the worst if we hit recession. So even in April, when stocks dropped 20%, they didn't close there. That's why it wasn't technically a bear market. But a lot of people aren't aware that it was Magnificent Seven that dropped the furthest. In 2022, when we actually had a bear market, well, no, we didn't because it only dropped 19.44%. It has about 20 to be a bear market, but we did have a correction. Again, it was the worst performers were Bitcoin and the Magnificent Seven stocks. So that's why we want to be rebalancing, right? So that we're capturing gains. And if things go really low and you had actually bought low instead of just riding the roller coaster, you'd have even more gains with both Bitcoin and the Magnificent Seven. You can see here that government bonds were the worst performers. And of course, this is not a video conference on fixed income, but we are going to be having a bond and what's safe without paper losses masterclass the Saturday after our financial freedom retreat. I encourage you to attend it. You should go to the retreat first because we spend one full day on what's safe at the retreat as well. So again, we're going to dive back into the hots rather than go into the safe, but it's worth mentioning, right? So again, the Magnificent Seven doubled in 2023, the All-Stars of 2024, but they were the worst performers in 2022. And by the way, in terms of diversification, if you didn't have large cap growth stocks, if you were a conservative investor, then you were performing at half the speed of the S&P 500. Because if you didn't have large cap growth, then you didn't get those spectacular above 20% gains in 2023 and 2024. The Dow, which had a lot fewer of the Magnificent Seven back in the day, now has NVIDIA. It was performing at under 10% annualized. So again, here's what happened in 2022. Oh, sorry. And here's what happened to Bitcoin, Tesla, the ARK Innovation Fund that had a lot of Magnificent Seven, even the NASDAQ, which is rich in tech and biotech, compared to the S&P 500 was a lot worse. So again, your sample pie chart, be sure that you're rebalancing once, twice, or three times a year. Be sure it's age appropriate. You'll notice that I have overweighted 20% safe in our sample pie charts, and it has a lot to do with all of that debt and a slower GDP. We're only expected to grow 1.4% this year, and that's if we avert a recession. Most economists have reduced the risk of a recession to like 35%, so more likely that we don't. But there's still always a possibility in there, right? And things can move very swiftly, especially when you see the amount of risk, the high levels of equities, which, just not great news can make them go down. We saw a tariff scare cause it to go down by, 19% in April, right? That was not so long ago. So important for us to be capturing gains. And with stocks at an all-time high, honestly, that's probably what's going to need to happen for most of us is that we should be selling high, capturing gains, getting age appropriate and properly diversified. So take a picture of this, but this is all of the benefits of our simple pie chart nest egg strategy. Again, it is literally as easy as a pie chart. It's less time, it's less money, it's easier to understand. And all you need to do once you set up that financial house properly is spring clean at least once a year. It becomes so much easier. And it's the truth rather than what we have seen, which is I do a lot of second opinions. And what I have seen, even with professionally managed plans by VPs of very, very, very famous banks, is that a lot of times they are putting people, especially conservative investors, into riskier things than the person realizes. And they might say, but you're earning 5 to 7% income. And I look at the statement and I'm like, yes, if you're just looking at the income, that is what you're earning. But if you add in expenses and paper losses, which are losses, you don't have that liquidity. The only way that you get access to that money is if you sell into the loss. And if the company restructures, you're forced into the loss, right? So it's more problematic than you might realize. Once you add that in, you might be losing money. So it's really important for you to understand, not just have blind faith in what you're being told, that you understand how to read your statements and that they're simple enough for you to understand. So again, a simple pie chart, Nilo and Bill did it and they made money in the Great Recession. This is true. That's their true testimonial. Nobel Prize winning economist wrote the foreword to my first book. He saw that the strategies would work. He knew it as an economist. Now they're time proven, right? So they had already been time proven in .com, but he said, nah, this is really going to work. This is something that even educated people need. And he was right because in the Great Recession, it worked like really saved a lot of people. So again, stocks are very expensive, and the only time they were more expensive than they are today was the dot-com recession. Look, they're more expensive today than the Great Depression. The dot-com recession, NASDAQ lost 78%. $1 million went down to $220,000. It took 15 years to come back. So again, when we see outsized expense, right, we see more volatility and a deeper plunge. That's, from history. So it's important for us to be rebalancing. And it's one of the reasons why we're overweighting 20% safe in our sample pie charts. So again, this tariff sell-off was a down 19%. Targeted funds, which I already showed you, help us to smooth out the volatility of investing in just one company, whereas regular rebalancing helps to keep us on the right side of the trade. Putting your hot slices in your tax protected retirement account will save a lot of money on taxes. And a few years ago, you couldn't do that with your Bitcoin. You can now buy Bitcoin or Ethereum ETFs and put them in your Roth IRA. No capital gains taxes and no income taxes when you take the distribution. So that's an important thing to be thinking about. And again, if you're on iShares and you could either do a search on it. I happen to know the names of it, but let's see what happens when we put in the search. So IBIT, right? That's the Bitcoin Trust. It's going to be trading at an all-time high, gang. So dollar cost average if you don't already have it. And there's the Ethereum Trust. So far, you can only invest, you can find probably anything off the boards, or if you did a Chat GPT search on it. You have to be very, very cautious of even the fund company. It should be, have a lot of money in it. It should have a very high credit rating and hopefully publicly traded so you know it's making money. So that's again why we're using iShares as our example. So just as a warning, when you wait for the headlines, it's too late. We're always early on that. So right now, stocks are at an all-time high. We have a warning saying overweight safe. And you can email us if you'd like access to our free web apps to personalize your own pie chart. Be sure that you're following us on social media so you know when our free video conferences are happening. Also, you get access to my updates. Look, ISPs are not great about always giving you our emails in a format that you can read. So here's all of them: Facebook, X, Instagram, LinkedIn, my Substack, my YouTube channel, email us. All of these are easy for you to access. And remember, if you do wish to come to our financial freedom retreat, register by July 31st so that you receive $200 off the regular price. Okay, so I'm going to go ahead and stop it here to see if anybody has a question, and then I'll come back and wrap things up. So again, thank you so much for joining me today. It's Natalie Pace. The website is nataliepace.com. The YouTube channel is Natalie Pace. Instagram is Natalie Win Pace, and email us at info@nataliepace.com. Thanks again, and share this with your friends. It's free.